Welcome back. Today on Money Talks, we're focusing on Hong Kong property stocks. Joining us from our Hong Kong studios to talk about the colony's property market, Peter Churchhouse, Head of Research at Morgan Stanley Hong Kong, and Vincent Look, Property Analyst at James Capel. Mr. Churchhouse, we've seen some foreign firms like Unisys just pack up their bags and move out of Hong Kong to areas of Asia where rents are considerably lower, like Singapore. Do you think that we're going to see more of this?
Yes, I think we will. I think we're probably not going to see a mass exodus out of Hong Kong in a wholesale sense. However, there are many financial institutions, like our own, for example, who could quite easily locate certain areas of our business or certain parts of our business elsewhere. And I think you will see that in the financial sector. We've seen certain companies in our own business who've used Singapore as their head office. And I think we're going to see that trend continue. And it's not just because of high office rents, it's also because of high labor costs, very difficult labor environment, and high residential costs as well. So I think you will see that as a trend.
Mr. Look, do you agree? Do you think that we're going to see more firms move out of Hong Kong because of not only the high rents, but the expensive business environment?
I agree to pretty much a large extent in that there is definitely a shift in the tenant profile of traditional Hong Kong business districts, in the sense that multinational companies are moving out of expensive localities to perhaps Singapore, say, and smaller, more financially geared tenants are moving into Hong Kong purely as the necessity for tapping Hong Kong as the gateway to China. But also, one must also consider that with rents in Singapore at, say, approximately 45 Hong Kong dollars per square foot compared to Hong Kong's 100 at this current on this current upcycle, in the past, Singapore rents were approximately, say, 25 Hong Kong dollars per square foot compared to Hong Kong's $55 per square foot. There has been an increase in the spread between Hong Kong rents and Singapore rents. We would argue that the point on here is the fact that people are looking towards China, and in looking at a viable business locality alternative, they would look towards Shanghai and Beijing. Admittedly, at this moment in time, they are not developed enough to accept the grade A quality locations that businesses usually require. And in saying that, then Tsim Sha Tsui offers a very viable alternative at roughly 45 to 50 Hong Kong dollars per square foot. And at this moment in time, we haven't seen a major relocation of the major anchor tenants from Central to Tsim Sha Tsui.
Mr. Churchhouse, would you say that China, though, is a bit of a wild card here because the economy, which has been overheating, some say is ready to crash, with a hard landing? Do you think that we're going to see businesses start relocating to China and take that risk because of the less expensive labor costs there?
Well, I think in certain sectors you're seeing that already, obviously in the industrial sector. But as far as the commercial sector is concerned, the financial sector, I think that's less likely the case in the short term. I take your point about the prospects of increasing business risk in China right now. We are seeing overheating in that economy, and I think the risks of quite serious economic dislocation have increased in the last 6 months. However, I think on a longer term view, cities like Shanghai may well become a very important focus for foreign businesses as the quality of infrastructure increases, telecommunications improves, quality of good office space improves over time. So 8 to 10 years from now, I could see Shanghai as a very important financial center in the Asian context, but I think it's going to take that period of time.
Mr. Churchhouse, we've covered a lot of the macro issues relating to Hong Kong's property market, and I'd like to shift to talk about some nuts and bolts investment approaches. As individual investors assess whether or not they want to get into the market to begin with or add to positions, how do they sort through all of these macro issues affecting Hong Kong's property market right now?
It's a very good question, and it is quite complicated, but I think there are two things that investors really should keep in mind. One is the differentiation between the investment property companies and the developers. The investment property companies are focused largely on building portfolios of properties, particularly commercial properties, for long-term rental purposes. Now, the developers, on the other hand, largely building flats for sale. And the two types of companies experience different economic forces and different determinants of demand and different income profiles. So I think one has to differentiate between the two. The investment property companies at this point are probably less risky, they're less volatile, and in some ways are a more defensive play on the Hong Kong property market, and we're recommending a strong overweight position in that sector of the market. The developer stocks, on the other hand, will be much more volatile. They are very cheap right now, but expect to see volatility if you buy into those stocks. They can go up quite sharply and they can come down quite sharply. But on a 1 to 2 year view, they will probably continue to outperform the market.
Mr. Look, there's clearly a division there that Mr. Churchhouse just outlined. Are there companies, property companies in Hong Kong that ever mix the two, that combine the flat, apartment development with commercial development? And is that a somewhat safer investment than the more risky, as Mr. Churchhouse put it, developer?
To be honest with you, even within the developers and the investor stocks themselves, they don't derive all of their income purely from property investment with regards to the investors or property development with regards to the property developers. Taking Hai San, for example, they derive approximately 70% of their income from rental, but for the other 30% and subsequent earnings growth, they usually rely on property trading. That is, selling off some of their less profitable properties and going out and purchasing ones that are slightly more profitable, or actually buying land sites and developing them. With regards to Hai San, they have taken this latter move within recent years more prominently with the development of the Lee Gardens Theatre and the Lee Theatre Plaza.
Mr. Look, what would you call a defensive play right now in the Hong Kong property market?
From speaking to quite a lot of US investors, at this moment in time, in terms of looking at the defensive play, they wouldn't look more towards property investors per se. More so, they would look at property companies who derive a diversified source of earnings with some of their rentals, with some of their income stream from property investment or development. But taking Wharf, for example, they do have a very, very large portfolio which they are significantly increasing with the completion of their Gateway project over in Tsim Sha Tsui. But they also have earnings from container terminals, cable TV, and some hotels, for example. And with regards to defensive play, if one was looking to be particularly bearish, then I wouldn't focus on either a developer or investor, depending on your own point of view. I would look more upon companies with a more diversified earnings stream.
Mr. Churchhouse, you said that the less risky play in the Hong Kong property market is the investment property company. Can you give us some names that you like particularly?
Yes, I think I agree with Vincent to an extent. The Wharf Company, for example, is what I would call a very rare animal in the investment world. It's what you would call a defensive growth stock, and quite frankly, there are very few companies around the world that both have a defensive nature to their earnings and also have very strong growth. Here is a company that has achieved an average, a 27% compound growth rate over the last 26 years. And over the next 2 to 3 years, we are expecting an average earnings growth rate of about 25%. Much of this earnings growth is very defensive in the sense that it is recurrent earnings. It is coming from rentals, it is coming from container terminals, it is coming from very straightforward recurrent sources where we're not going to see a great deal of volatility. Companies like that, companies like Hong Kong Land, similarly, we're going to see very steady earnings potential here. Also Hai San Development, again, well over 60 to 70% of their earnings is coming from recurrent sources. So I think in that sense, these are the sorts of companies that I see in the property sector as being some of the most defensive, but also have very good growth prospects. And that's a rare animal indeed in the global investment environment.
Okay, we'll have to leave it there, and I'd like to thank you both for joining us today. We've been speaking with Peter Churchhouse, Head of Research at Morgan Stanley Hong Kong, and Vincent Look, Property Analyst at James Capel.